Ever since taking measures to boost the economy in the wake of the last financial crisis in 2008, China's leaders have been preoccupied about inflation. Banks were seen to be lending too much, too quickly, leading, among other things, to unsustainable rises in the property market. So the People's Bank of China reined them in, forcing them to keep more of their assets in capital. Now, for the first time in 3 years, China has loosened those reins.
In the past 3 years, the Chinese government has been conducting a tight monetary policy to control inflation. And I think the government has the faith now that the inflation has peaked, and then now it's time to change the monetary policy from a tight one to a loose one.
It's not just peaking inflation, it's a cooling of demand for China's exports. Figures out on Thursday confirmed that November saw the first reduction in Chinese manufacturing since February 2009, thanks largely to the European debt crisis and a struggling recovery in the United States. A sign of just how serious are the concerns came from Vice Finance Minister Zhu Guangyao. The current crisis, he said, to some extent is more serious and challenging than the international financial crisis following the fall of Lehman Brothers. Some countries have very difficult fiscal situations, and there is limited room to adjust monetary policies. Nonetheless, Zhu called for worldwide efforts to stimulate growth and appealed to European leaders to settle their rescue package for the Eurozone at a summit on December the 9th. Harry Fawcett, Al Jazeera.